Hello everyone. Today I'll be making the first video of my trading course. That's the trading mastery course, and today will be the first episode. So today we shall be tackling a very important topic, and that is the market structure and order flow topic. So this is a very sensitive, and I can say this is the basics to trading. So if you have covered this, the rest will not be a big issue. So we're starting with market structure, and to simplify it, we shall be talking about the trends that are involved in the market, on the order flow, and how we shall be taking our trades. So this is I can say this is the basics and the starting of understanding forex at a beginner level. So let's jump straight into the video. So the first thing I will be talking about is how market moves. The market moves in let me say in cycles. So the first cycle is the type of cycle that where the market is moving to the upside. The second cycle is when the market is moving to the downside, and the third cycle is when the market is moving to the sideways, otherwise called sideways market or consolidation. So these markets, we do name them in these manners. So this one is an uptrend, or otherwise called bullish trend, and this here is called a downward or bearish trend, and this is called the sideways or consolidation. So these are the three cycles that the market goes through, and as a trader you want to be focusing on only two of these, and that is the uptrend or the bullish market, or the downtrend or the bearish market. That's to say, so for us as traders who know what they're doing, or don't want to be caught in a situation where the market is doing nothing serious, you should avoid this type of trend, and I will show you how to spot it in a few, so you can be avoiding it and only focus on this two type of trend, that is the bullish and the bearish. So let's get straight in. So we shall start with the bullish market, or the upward trend. And the upward trend, identifying it is quite easy. As I said, it's a market that's going to the upside. So a market that's doing a series of an upward push, a downward push, then again an upward push that makes a higher high, then a higher low, a higher high, a higher low, and a higher high. This is how we identify a bullish market. And another way to identify this by marking out the highs and wait for the market to break them. As the market breaks them, that identifies that the market is continuing into a bullish direction. And what we should be doing is anticipating more bullish potential, or let's say more upward potential to come in. And as the market breaks this high, there's something we call consolidation. It's like a short-term movement against the overall direction before we get the original direction, which is this. So this move here is called a correction phase, which is exactly this phase here. So as I said, when the market breaks this high, which is a high high, and makes a new high high, we anticipate it to make a correction phase to reach into here and reach a discounted level, and most of the time it comes to a level of about 50% of the move. And by the move I mean this move here. So the market will have to cover at least 50% to 80% of the move that it made here. And as you can see with my drawings, it did that, coming to this point, and this is where we get our buys or bullish trades to continue with the direction. And in a later video I will show you how exactly we shall be taking our trades at such a point when we get it in the near future. So for now, let's keep focusing on the three types of trends and we finish them. So as I said, the correction phase is very important. As the market breaks this high and reaches to this extreme new high, we have to wait for a series of pushbacks, or let me say corrections, to take us to a point of supply or demand. And supply or demand, there's a specific episode for it that I'm going to be making that will show us how we take our trades based on these two concepts, supply and demand. And this is the point where we buy to make new highs, breaking this previous high, making this new high. So now, as I said again, there's a series of pullbacks or corrections, taking us again into a discounted area, which is called the pullback. So is where again we take our series of buys, push us higher. So this is how we deal with an upward market or a bullish market. So the next thing we shall be talking about is a downward trending market. Downward trending market is just the vice versa, or the opposite of what we just learned, which is the bullish market. So the bearish market takes the form of this, and I'll explain. It's where the market is making new lows, new lower lows. So there is a previous low, then the market breaks it, making a new lower low, then it does a correction phase into a discounted area, whereby gives us more sells, and from here again we sell, making a new lower low, breaking the previous lower low that we just made. Then it makes a lower high, then again it makes a lower low, a lower high, lower low, and as long as it continues breaking these lower lows, the market will continue to be termed as a bearish market. So a bearish market is a market that makes a series of lower lows and lower highs, while a bullish market is a market that makes a series of high highs and high lows. And the final and third one is the sideways market. As I said earlier, the sideways market, we have to learn to avoid trading it, and spotting it is quite easy. So it's an area where the market is quite not making new highs or lows, exactly as this. So you'll find a market that is relatively not making a new high or a new low. So in such a market, we must learn to avoid trading until something that we call a breakout or a new lower low or new lower high and high high is made. So in such a situation, we must wait for the market to take out this low and make a correction to such an area that we call an order block. Before we do it, we can sell the market, and this sell will be inspired by this break of this area. Since this area was consolidating, now when the market takes it out, it will show to us that this trend now is changing to the downside. And also the vice versa is true. When the market is changing to the upside, we must wait for the market to take out such a high that was holding this sideways market. Yeah, so the market must do such a scenario whereby it takes out this high. Then now it will trigger to us that there's a possibility of this market going higher. Then we wait for a series of pullbacks to an area of supply or demand. Then from here we can look for buys. So it's as easy as this. The market is divided into 3 cycles. That's the upward, the downward, and the sideways. In other words, that's the bearish, the bullish, and the sideways market, or the consolidation market. So without any further talking, let's end this video of market structure where it is now, and we shall get further into episode 2 with a different topic about trading and how to master trading.